Why don't we get started?
Yeah.
Moderator? Cat. All right. So thank you everybody for joining our seminar today. We're gonna talk about investing and also talk about 1031 exchanges and how they relate to investing. So we're gonna get started, and why don't we go to the next slide? So topics for today, as I just mentioned, we'll do some introductions for the guest speakers that are joining us today, taking time out of their busy schedules. We'll quickly cover Investing 101, so a high-level overview of investing. And then as we get through investing, we're gonna start talking about 1031 exchanges and how they play a role in investments, at least from a real estate perspective. And then we'll leave a little time at the very end for questions and answers. Now for questions and answers, definitely you can ask questions throughout the seminar. Just send over those questions through chat, and then we'll try to address them either as we go through the seminar or at the very end, depending on time and if we have any stopping points. Okay. All right. So investing. Oh no, introductions. That's right. So my name's Lawrence. I'm co-founder and director of operations for Kia, and over 30 years of experience in real estate, both on the sales, purchasing side, as well as the investment side. And so we're really excited to be able to share some of that knowledge that we've gained over the past few decades, and also introduce you to some real professionals in the field of real estate investments on the exchange side. And the first person that we're going to introduce is, I believe it's James, right? Yeah. James, you want to say hello and tell everybody a little bit about yourself?
Sure. Hi, everyone. I'm James Callejas from IPX 1031 Exchange. In July, it'll be year 25 of doing 1031 exchanges. I've helped people do the regular forward exchange, the reverse exchange, the improvement exchange, the personal property exchange when it existed, pretty much any kind of 1031 exchange. And our motto is take the pain out of the gain and help you build wealth within your real estate portfolio, not giving Sam, Gavin, and any of their friends any of that piece of the pie, which they truly don't deserve, and let that equity work for you to truly diversify your real estate portfolio and get investment property that performs superior to what you currently have. So our job and my job for the last quarter of a century is making those dreams come true, getting out of a nightmare that they currently have in terms of investment property into truly something that can change their lives in terms of investment property.
Awesome. Thank you for that. And James' cohort and colleague, Ross.
Hey, yeah. Ross Fong. I've been working on 1031 exchanges for a tad over 25 years. I've worked on probably, I'm guessing, somewhere between 20 and 21, 22,000 exchanges. I've worked with quite a few of Lawrence and Melanie's clients, 1031 exchanges over the years. And just like James, we're just here to help and answer questions that you have on 1031 exchange.
All right, just to set expectations, Ross and James can probably talk about 1031 exchanges for days on end without stopping, but we're not going to have that much time. We're going to give you a good overview and talk about why it's important, and hopefully they'll be able to share some real-world experiences of things they've seen, both good and bad, and why it's important to work with somebody very professional and knowledgeable, such as these folks over at IPX 1031. Now, investments. Now, when it comes to investments, it's all about a rate of return at the end of the day, right? And so a rate of return, just in layman's terms, is a representation in a percentage format of either profit or loss when it comes to your initial investment. So if you had $100, you invested in some stocks and you earned $10 at the end of the year, you got a 10% return on your investment. It's as simple as that. Very, very simple math. Now, when we talk about investments, people usually think stocks, right? That's the most common, and that's what you see in the news. You always see talk about the stock market, talk about the Dow Jones, talk about the NASDAQ, and talking about the S&P 500. Now, when we look at the average return on investment for the S&P 500 since inception, it's usually been about 10%. That's their annual average return. It might be a little bit less, it might be a little bit more depending on who you talk to. But why we call it a bellwether is because the S&P 500 just performs very consistently compared to the other indexes out there. We're not going to dive into the difference between Dow Jones, NASDAQ, or S&P 500, but S&P 500 is essentially, it's a group of 500 really strong companies that represent what we like to think of as the US economy, right? And so 10% annual return, pretty good. If you invest in the S&P 500, that's a pretty safe investment, and you should be pretty proud that your money's working for you while it earns a good return over however long you invest in it, right? Now, the other option is when we talk about real estate, right? Everybody talks about real estate, and that's why we're here today. And if we look at the San Francisco Bay Area, and we're not going to go back that many decades, but if you go back 30, 40, even 50 years, definitely less than how long the S&P 500 has been around, the average return has only been 6% on average, right? And we're looking conservatively, right? We're not looking at specifically San Francisco, we're looking at the whole Bay Area. And so is this really apples to apples comparison? 10% versus 6%? Why would we invest in real estate if you're going to get a better return on investing in the S&P 500, right? An index fund. Well, the reality is it's not an apples to apples comparison. And so as we get into the next slide, what you start to learn about real estate investing is that there's 4 profit centers to real estate investing. That first one we just saw on the prior screen, 6%, that's like an appreciation return. And that just represents one sliver of your real estate investment strategy, right? And appreciation, I think that's pretty simple for a lot of people. It's you have some type of real estate, and over time it just is worth more, right? You might bought it for $500,000, now it's worth $750,000, right? So that's what they call appreciation. And so you do get a return on your investment from appreciation, but that's not the only return that you're going to get. You have multiple profit centers. So the other profit center most people are familiar with is cash flow, right? If you have somebody living in your rental property, you're renting it out, you're getting rent every single month. That's your cash flow. So if you had a $100,000 investment in a rental property, and at the end of the year, you ended up having $10,000 in rental income, then you earn yourself a 10% return on your investment through pure cash flow, right? Obviously, we're not talking about expenses and things like that, but the assumption there is $10,000 rental income net, right? So after all the expenses and things like that, just to make things simple, right? So you get another return other than appreciation. So if you start to add these percentages together, you see that you're starting to get a little bit higher. It's not just 6% anymore. You're getting a little bit more, you're getting a little bit more. Now, the more complicated ones are amortization, depreciation. Amortization is a really fancy word to just your loan. It's just buying or paying down your debt. So for a lot of people, you're not going to buy something outright with cash. Well, though there are some people out there that have that. There are a lot of people that buy things with debt, right? And so they get a loan from a bank and they have an interest rate on it and they get a 30-year loan. And so over those 30 years, your loans amortize. And so you pay a lot of interest up front and a little bit of principal. And over time, that kind of flip-flops. And then you pay more principal as you get towards the end of the loan and you pay less interest. But that idea of paying down your loan or paying down your debt is another way of getting some type of return from your investment. Because the reality is, if you have a renter in your rental property, they're helping you pay your loan, right? And that every little bit that goes to your principal, that goes to your bottom line. So in addition to the rental income that you get, you're actually getting money into your property in terms of equity. And so there's a return there, right? That just adds a little bit more in terms of percentages onto your overall return. Now, depreciation, the last major profit center for real estate investing, is great. It's not something that is much easier to explain. They call it almost like a phantom return because you don't get any money out of it. It's more almost like a tax shelter. Depreciation at the end of the day is an operating expense. The government or the IRS allows you to take an asset, a real estate asset, and lets you depreciate. And we're talking about the depreciation of the actual physical structure of your real estate. You can't depreciate the total value. So if you had like a property that was $1 million, you're not depreciating $1 million. You're depreciating whatever is the physical structure, not the land. And there's a difference there. So it would probably be less than $1 million, but nevertheless, you can take that and doing a simple like straight line, 27.5 years, you can divide the total value of your structure over 27.5, and that would be operating expense every year, right? So for ease of math, if you had a property that the structure was worth $275,000, right? Over 27.5 years, you would be able to deduct $10,000 every single year as operating expense. So if you imagine you had $10,000 in rental income for that year, you had $10,000 in depreciation, that washes out to zero, right? Your income is 10,000, your expense is 10,000, and so your net income is zero. Why is that good? It's because of what James was talking about earlier about Uncle Sam and the Gavin, the Franchise Tax Board. They want to tax every bit of income that you generate. So if you're able to shelter your income through depreciation, you're actually saving, right? Because most of us pay taxes, and we pay taxes, quite a bit of taxes. And so for every dollar of income that you have, if you had to pay taxes on it, ordinary income in the state of California, your investment tax at ordinary income, right? So the reality is you don't want to have to pay if you don't have, if you do not want to have to pay taxes if you can avoid it, right? It's not tax evasion, it's tax avoidance that we're trying to figure out here. And so depreciation helps you accomplish that, right? And so that gives you another few percentages. And so you now see you got 10% of the S&P 500 over here, which is great return from a stock investment, but now you understand why you want to invest in real estate, because you don't just get 6%, you get a lot more than 6%. And you're looking at double, triple, quadruple, depending on your real estate investment. And so it's a no-brainer, right? It's a no-brainer when you look at real estate investing compared to a traditional investing like stocks that a lot of people are familiar with. Okay. Now, you think that for-profit centers is really great? Wait till you see this next slide. The X factor. What's that? So let's, for example purposes, let's say we didn't have cash flow, we didn't have depreciation, and we didn't have appreciation, right? Or actually, it would be appreciation. Let's just say there's no amortization. The X factor is what we call leverage, right? And OPM stands for other people's money. In this case, the other people that we're talking about are banks. So if you get a loan to buy an investment property, you put 20% down. You're only putting $20,000, but you might be buying something that's worth $100,000. So if you had a choice of investing in the stock market and putting $20,000 down and earning a 10% on that $20,000, or would you rather have $100,000 and invest in real estate and get a return on 100,000, even though you're putting in 20? So you get a multiple effect here. So when you look at appreciation, that 6%, you're getting 6% on 100,000 instead of 10% on 20,000. So 10% on 20,000 is only $2,000 a year. Would you rather have $2,000? Would you rather have $6,000? So you see how the numbers start to play out when you combine that X factor with all the other profit centers. Real estate investing just makes a whole lot of sense. And that's what we're hoping to try and teach you guys here today, is that real estate investment, when done right, with the right professionals, the right people in your corner, the right partners, you could be really successful. So I think I had a case example, and I think I talked through most of it, but I give my take on something that is debatable for a lot of people in terms of cash flow and appreciation. And a lot of people, they complain about, wow, in San Francisco and the Bay Area, it's really hard to find positive cash flow. What's positive cash flow? Positive cash flow at the end of the day is having more income than you do have expenses, right? And in the Bay Area, because property values are so high, trying to get in, you spend a lot of money. And so you spend a lot of money, you have higher property taxes, and you have a higher mortgage. And when you have higher property taxes and mortgage, which are the two biggest expenses for you in real estate investment, you might not always have positive cash flow. You might have negative cash flow. So the question is, why would you want negative cash flow? Is that a good investment at all? Might not be, and that's where it gets debatable, right? My thought on this is something that exists for a lot of people in terms of a debate between appreciation and cash flow. So for a lot of people, they don't want to invest in the Bay Area because it's too expensive. So they rather invest out of state. Because out of state, you can find properties for hundreds of thousands of dollars instead of millions of dollars. You can find properties that are less than $100,000. The example that I usually give folks when we're talking about investments is, when you look at out-of-state investments, a positive cash flow of just a couple $100 each month is really good. If we wanted to be a little bit liberal with that, we could say $1,000 every single month of positive cash flow. Probably unheard of in the Midwest, South. But let's just say you did get $1,000 positive cash flow every single month. Over the course of a year, that's $12,000. Not paltry, it's pretty good. Over the course of 20 years, that's almost $250,000, right? In 20 years' time, if you look at the home prices in San Francisco or the Bay Area over 20 years, have they appreciated more than $240,000 in 20 years? Certainly. I remember a time when Ross lives in Sunset, right? I remember when homes couldn't find a home more than $1 million in Sunset. And then about a year and a half ago, one of our colleagues sold a home for over $3 million in the Sunset. Oh my gosh, it's just insane. So appreciation, some people say that you just can't beat it, and they rather have appreciation than cash flow. That's not to say you're not going to have properties that appreciate over time in the Midwest and South, but they don't appreciate at the rate they do in San Francisco or the Bay Area. So if you're still looking to invest in San Francisco or the Bay Area, still a lot of good options out there. They're hard to find, but if you have a good partner, we can help you find it. Now, real estate investment isn't just about holding something for a long time, right? When you go to the next slide, we're going to show you what it really looks like from a life cycle perspective, right? When you start to think about real estate investment, you have to identify an investment that you want to purchase, right? And you have to do your due diligence. You have to make sure that's the right investment, that there are no hidden problems, that you're really getting a good real estate property that you believe is going to do well for you from an investment point of view, right? And then you go through the acquisition, and then you have to manage it over the period that you're holding it. And then eventually, down the road, you're going to sell it, right? What we talk about with the real estate investment life cycle is that, yes, real estate investments is a long-term hold, right? You hold it, but when do you let go of it? When are you not holding it anymore? When do you sell the property? And that's the big question. What's your exit strategy, right? And the exit strategy usually goes back to those 4 profit centers that we talked about earlier, right? When you start to see your return on investment start to go down instead of go up, that's probably a good time to exit your investment and think about next steps. And how do you know when that timing is right? It's actually pretty calculated in some cases, right? It depends on your lending. So your financing, if you have a loan that's 30 years, after 30 years, you fully paid your loan. That means you have all this equity in your property and it's not working for you anymore because it's tied up, right? So some people say that you can take that equity out through refinance. Yeah, you certainly could take all the cash out and reinvest in something else. The other alternative is you can sell the property too, and then you would have all that. But what would you do with all that? You would ideally reinvest it. And that's where we're going to start talking about 1031 exchanges in a little bit. But the other piece of the very calculated, when do I sell, when's that exit strategy, is with depreciation, because IRS has a very specific rule about depreciation. And the rule around residential real estate is that it depreciates over 27.5 years. So we're not going to get into more complicated things like accelerated depreciation, but let's just say you took a straight line approach. You took the value of the structure, you divide it by 27.5 years. After holding a property for 27.5 years, you just don't have any more depreciation. There is zero. So you have no more tax shelter. So you're having to pay taxes on that extra income that you can't protect anymore. And so around that time, which sometimes really closely aligns with a 30-year loan, is a good time to start thinking about selling, right? Because you're just not getting as good of a return. But the problem is when you sell a property, Uncle Sam and the franchise tax board boogeyman come knocking, and they want a piece of the pie, right? They want to tax your capital gains. So how do you protect yourself from having to pay taxes on your property? And you remember that example about holding property for 20 years and how much it appreciates. If you held the property for 30 years, you know how much capital gains you have? It's going to be in the hundreds and hundreds of thousands of dollars likely. And when you look at a tax rate that's probably going to go north of 30%, right? Capital gains is 15, but it can go up to 20. And then in California, you got 13.3%. And capital gains is always taxed at ordinary income, right? So you're already 30-something percent. Would you like to keep, if you had $300,000 gain, would you like to keep $100,000, or would you like to give it to the government? And that's where I'm going to hand it off to James and Ross, because they're the ones that can really talk to you about how to avoid paying those taxes and figuring out a way to continue to build wealth through real estate by scaling up a la 1031 exchanges.
Excellent. Like a lot of the things that you said there, and it kind of rings a bell. My grandparents emigrated from Central America in the mid 30s and bought in Bernal Heights in San Francisco. And that 20-year thing truly comes true when you look at the original purchase price of $1,700 on a 3-2 1,200 square foot home on a 3,500 square foot lot. That same property today would go probably just a tad under $2 million. We're really exceeding these 6% numbers. That San Francisco Bay Area doesn't account for these baby boomers, or actually, I don't even know what my grandparents are. What's before baby boomer is just something ridiculous, right? The amount of money they make on this. And, I teach these classes all the time, Lawrence, and I truly want everybody on the call to understand that you really hit it on the nose when you talked about the 4 reasons why people own investment property. And quite often people think they sit on a cash cow, and it really doesn't make sense any longer. It's a fully depreciated asset. It's fully amortized. The cash flow is truly underperforming considering the amount of appreciation that they have in the asset. And if we're talking in the city, then a lot of the times you're subject to rent control. So you really are under a 1% return on the investment. And the bad news is, yeah, you're going to have to pay Gavin, Sam, Barack, and Joe, and everybody else if you were to cash out. And that's where the hesitation sometimes occurs. And there was one thing about that slide that you didn't mention, and I think that's a good segue to this, is that, yeah, the S&P may give you the 10%, and that 6% really isn't 6%. I think we learned that today. But the 10% really isn't 10% either, because when you sell any of these stocks, there is no 1031 exchange for selling stocks. I mean, you could go into opportunity zones, but we're not even going to talk about that today on that exit strategy, which I really don't think is a good exit strategy for a number of different reasons. But when you talk about real estate, we've learned that we can amass a lot more than 6% for a variety of different reasons. But the cool thing, and I got to tell you, there's nothing out there like this. The 1031 exchange is the greatest wealth building tool that truly exists. And I think that this is augmented when you talk about the Bay Area, when you talk about California in general. You can make millions of dollars on an asset, sell it, and not pay anything in capital gains tax. And not only that, you could go into an asset that is a superior piece of investment property. You could change product type. You could go and get a different depreciation schedule. We were talking about 27 and a half years. That's just for residential property. Now, if we go into commercial property, we'd have 39 years to depreciate it, and we can get a new depreciation schedule because this property is free and clear. We could leverage into an asset, and everything up and above that dollar amount that we sold for will have its new depreciation schedule. So there are so many different things that just ring so true with what Lawrence was illustrating. I could talk, it's not days, Lawrence, it's probably weeks, maybe months on 1031 exchanges. We used to actually give an 8-hour class on this, and I had to do a few of those by myself. So it was just horrible. And good at the same time. That's what we call a paradox, ladies and gentlemen. But let's start off with a real quick definition of a 1031 exchange, because I want to make sure everybody understands this. And then we're going to go into the true value of the 1031 exchange as the ultimate wealth building machine. 1031 exchanges it's only for investment property. So I want to make this crystal clear. This is not for every single property that you sell. Now, there are 3 pieces of real property that do not qualify for the 1031 exchange. Number 1, the primary residence does not qualify for a 1031 exchange. If you've lived in it 2 out of the last 5 years, you can protect 250 of it. The gain, that is, if you're single, 500. If you are married, quite honestly, that's really not that much when you're talking about the Bay Area. The cool news is that you could actually live in it as your primary, move out of it, rent it for a year or 2, sell that asset, still get the 250, 500 because you lived in it 2 out of the last 5 years, and then 1031 exchange the rest. So even though it doesn't qualify, there are ways that you can make it eventually qualify. And even sometimes, particularly in San Francisco, the primary residence may qualify for a 1031 exchange because in the city, we have so many mixed use properties. We have a duplex where they live in one unit, rent the other one out. You have a storefront downstairs where you live upstairs. You have so many different places. And then we were talking about where Ross lives in the Sunset. I got to say, I don't know. I went to school in the Sunset District. And all my friends out there, I'd say maybe 85% of them have in-laws in their houses. And a bunch of those are rented out there. Another mixed use property. We just went through COVID, right? How many people work out of their homes? Another mixed use property, the percentage that they're claiming on their taxes for investment purposes. So the primary residence doesn't qualify for a 1031 exchange, but sometimes it really does when it's a mixed use asset. And sometimes when the primary residence has significant gain and people don't want to sell the asset because they don't want to realize the taxes, they convert it to investment property so they can still keep the exclusion money, the 250, 500, and 1031 exchange the rest. The second piece of investment, or the second piece of real property that doesn't qualify for a 1031 exchange, is a second home. Second home doesn't qualify for anything but taxes. So it's real simple. Convert your second home to investment property. The criteria is simple. Rent it out 14 days out of the year. Don't use it for personal use more than 14 days out of the year. You can Airbnb it, short-term rent. You can rent it full-time if you want more cash flow. But that's all you have to do, and do that for 2 years, and you sell it. Qualifies for a 1031 exchange. The third piece of real property that doesn't qualify for a 1031 exchange is the flipper. So if you buy it, fix it, and sell it, it doesn't work because that's property held for resale purposes, and that does not qualify. What you need to do is buy it, fix it, rent it. How long do you rent it? It's up to the CPA. This is a gray area. It's not black and white. So I'll tell you this, the aggressive CPA says a year and a day because that's the definition of a capital long-term investment. The guy that's kind of in the middle says let's cross 2 tax years, and then the conservative cat says 2 full years. And there's a rev proc that actually supports that. So what I tell people is if you're going to do it for 2 years, rent that is, don't ask anybody, you're good. If it's going to be less than 2 years, just make sure your tax advisor's on board. Every other piece of real property qualifies for a 1031 exchange. You sell investment property, you buy investment property, you follow these simple guidelines that I will review, you will be in a position to defer all capital gains tax. And I got to tell you, I have so many people that call me and say, you know what, James, I was told to call you, but I'm done. I'm just going to pay the 15%. And that's when I pull what you're talking about, Willis. Only the old school people really understand what that means. It is not 15%, okay? Federal tax is either going to be 15 or 20% unless you make absolutely zero money. And even then, you made money on the appreciation. So you'll hit that 15 or 20. State tax is either going to be 9.3, 10.3, 11.3, 12.3, or 13.3. It's all based on your adjusted gross income. Obamacare, which is still in effect, is 3.8% once you cross the threshold. And let me tell you this threshold is not even that high. As a single person, once you make 200,000, kick on an additional 3.8%. And as a married couple, one would think 200 translates to 400,000. It really only translates to 250. So as a married couple, once you cross 250, tack on an additional 3.8%. And then all that lovely depreciation that we have claimed throughout the life of owning this investment property, Uncle Sam will recapture 25% of it. It's bad in California. You're not going to probably get out of it paying less than 30%. And if you're high net worth, well, in San Francisco, you probably are. You're probably closer to 40% that you would pay in capital gains tax. So when people say, I'm just going to bite the bullet, truly understand that that bullet hurts a lot more than you think it does. And most people reconsider and do the 1031 exchange. So here's how it works really quickly is you analyze, this is how it would work for me. At some point, the investment property no longer makes sense. We talked about what a 1031 exchange is. Well, here's why we do a 1031 exchange. Number one answer I hear out there all the time. I do a 1031 exchange to avoid the capital gains tax, defer the capital gains tax, not pay the capital gains tax. All three answers, wrong. We do not do a 1031 exchange not to pay the capital gains tax. If I don't want to pay the taxes, I don't sell. I do a 1031 exchange to get a better piece of investment property. I want everybody to understand this. The return on the investment no longer makes sense after a period of time, or it no longer makes sense because it's a nightmare. For whatever the reason is. Maybe it's a soft story problem in the city. Maybe it's a rent control problem in the city. Maybe it's just the tenants, the trash, the toilets, the termites, the taxes, and all those terrible T's that you can't handle any longer. Now we want to sell the asset and do a 1031 exchange. We got to be very crystal clear that people do a 1031 exchange to get out of a situation that no longer makes sense for them. And sometimes it's a cash flow thing. Sometimes it's an expired depreciation schedule. Sometimes, this is true, 25% of our clients at a minimum, and it's higher for commercial property, leave the state of California. They're just tired of California. So there is a variety of different reasons. I could name 20 or more of why people do 1031 exchanges. honestly the big benefit, not paying the taxes. We all understand this, but the real reason they're selling it is to get into a better piece of investment property. So let's just say it's my parents, right? They got the 3-unit building in Noe Valley in San Francisco that they bought in 1970 for $50,000. That's worth $3 million today. The problem with that property is fully amortized, fully depreciated, massive appreciation, stuck in rent control, 2 grandfathered clients in there that make no sense on this asset. And the property was built in 1914. So you can imagine the headaches that this property currently has on it. And my dad's the blue collar guy that still works on it. And I'm not young, so he's really old. So we have so many people in a scenario where they still work on the property, it no longer makes sense. So here's how it would roll out. Decide to sell the asset, put it on the market, eventually accept an offer, open up escrow. I would recommend that either you contact Ross or myself prior to listing the property for sale, just to make sure there will be no hiccups. It could be a conversation that will last between 3 to 5 minutes, because a lot of the time we get people saying, oh yeah, the buyer couldn't get financing, so they wanted me to carry. So we're going to carry and provide seller financing for the buyer. This is not a good thing in a 1031 exchange. Or sometimes it's people that say they own the property, yet they don't own the property. It's not in their name. It's in an LLC. It's in an S Corp. It's in an C Corp. There's multiple owners of that property. So we like to have that brief conversation. Well, let's just say it's real easy. John Doe owns the property. John Doe listed for sale. Accept an offer, open up escrow, then we get involved as the qualified intermediary. That's what we are. You need someone like us to create the 1031 exchange account, to create the legal documents, because essentially we become the seller for the seller. If the seller touches money, it's taxable. So they can't touch money. So we assign into the rights of the contract, act as the seller, set up a 1031 exchange account so that at the close of escrow, the proceeds will go into the 1031 exchange account. So that's why we need the contract. We also need the preliminary title report from the escrow officer, because it will show who owns the property. We care about the vesting. The taxpayer that operates and owns the property should be doing the 1031 exchange. And if I see an issue, I will talk to them. That's why I like to have the conversation in advance, so there will be no issue. But let's just say it's John Doe. John Doe closes escrow on May 1st. From that date, this is what starts the roller coaster ride. You have 45 calendar days to identify. Calendar days means that even for my birthday, New Year's, 4th of July, or when Lawrence is having the big soiree at the Geary Street hideout, no extensions on that. No matter how much you drink, they will not give you an extension on the 45-day window. You have to identify in writing exactly what you're going to buy, and you can't make it general. It has to be very specific. So you will have an option of what you can do. Number one, you have to identify like-kind property. I say like-kind because you're going to hear it out there in the industry. This is what like-kind property means, because I don't want there to be any confusion. Most people think, oh, they're selling a 3-unit building in San Francisco. Now they have to buy a 3-unit building somewhere else, or some other multifamily property somewhere else. That is not the case. When you are selling an investment property in a 1031 exchange, all you have to buy is another piece of investment property. Here's the criteria. If it's real property, not personal property, if it's real property used for a business or investment purpose anywhere in the United States and even some US territories, it qualifies for replacement property. So you could sell the 3-unit building and buy an office building, buy a self-storage facility, buy an industrial building, buy a bunch of condos that you're going to rent out, townhomes that you're going to rent out. You could buy so many different things in a 1031 exchange. All you have to do is let us know what you want to buy, and we will let you know if it does or doesn't qualify. It is as simple as that. Can you share with me your contact? Okay. Lawrence, we could do that later, right? I was just reading the chat thing. Absolutely. We'd love to do that. So 45 days to identify. And it's not like you can give me the entire MLS. Here, I have identified. Doesn't work like that. Yes, that's specific. We'll have those addresses, but you are limited on what you can identify. So there are 3 rules that you can choose from. Number 1, the 3 property rule. The 3 property rule says that you can identify up to 3 properties of any value. This is used for the person that's looking to buy that big property, usually maybe 1 or 2 properties. There's no limit on the value, but you can only identify 3. Don't have to identify 3, that's the max. But what about the person that sells out here in San Francisco for $2 million and says, you know what? I'm done with California. I want to go to a state tax-free state. And I'm thinking Florida, I'm thinking Texas, I'm thinking Tennessee, I'm thinking Nevada, I'm thinking somewhere else. And what I'm looking to buy is condos, townhomes, single family homes, probably about 10 of them. And I know the 3 property rule, last time I looked, 10 is greater than 3. We can't use that rule. what rule do we use? And I let them know the second rule is called the 200% rule. You sold for $2 million. That's the gross sales price. Multiplied times 2, that gives you $4 million. That is the cap. That means you can identify a total of $4 million worth of real estate. Don't have to close on 4. Want to close on at least 2 to pay no tax, but that could be a variety of different properties, more than 3, to equate to that 2 million mark or greater, but not to exceed 4 million. So to me, it's real easy. If I'm looking to buy a lot of smaller properties, 200% rule. If I'm looking to buy the big bad boy, 3 property rule. If I am a gambler, I'll use the third and final rule. It's called the 95% exception. This rule says you can identify as many properties as you want, no limit. And there's no limit on the value either. So as many properties as you want, no limit on the value. But here's the catch. You have to close on 95% of the value that you identify. Well, you know, the way that translates is you have to close on everything that you identify. And if you don't, your entire exchange will fail. So in our career, I think between Ross and myself, we've handled somewhere close to 50,000 exchanges. We've seen this rule utilized under 10 times and failed a few times using that number. So it's probably going to be the 200%, the 3 property rule. You're going to identify like-kind property, and you're going to make this all magically happen within 180 days. And as long as you can achieve that, you'll be in a position to fully defer all of your taxes. I want to make a couple of things crystal clear, because we hear this all the time. Let's say on the initial investment property that we're selling, let's just say for $1 million, we bought it for $200,000. We put $50,000 down when we first bought the property, 25% down, bought it for $200,000. Now it's worth $1 million and we're selling it. Many people think the target price is $800,000, just the gain. That is not correct. Let's say that the property was refinanced over the years and it's leveraged 50-50, right? There's a $500,000 loan. A lot of people think just reinvest the equity and you're good. That is not the case either. The way the 1031 exchange works, and this is what the unfair part comes up all the time. And I almost argued with this lady today because she thought, I guess I was the IRS. I'm not the IRS. I'm just telling you what will happen if you battle the IRS. A lot of people think that the initial down payment, that $50,000 that buyer came up with initially, should come back to them and is not taxable. I tell them that $50,000 is not taxable. You are correct. But if you take the $50,000 out, the IRS has the standpoint that that $50,000 you're taking is from the appreciation, not the original down payment. And then the client was telling me, no, it isn't. This is my money. And I'm like, okay, you could have that discussion and probably will turn into an argument with the IRS, but you ain't going to win. So keep this in mind. Every single cent that comes from the sale of an asset should go towards the replacement property, unless you are okay with keeping some and paying taxes on some. You don't have to put all the money in the exchange, but every dollar that is not used, every dollar that is kept is taxable. Most of our clientele, all proceeds into the exchange account, buy a replacement property of equal or greater value. And if I only have 500,000 and my target price is $1 million, that means I paid off a loan of 500,000. I need to replace that debt with a new loan or new cash to get to that dollar amount. These are criteria that we all need to understand, so we don't get in the middle of a 1031 exchange saying, oh, you never told me. Or I thought I just had to reinvest the equity, or I thought it was just the gain portion. That is not how 1031 exchanges work. This is a beautiful tool if used correctly and planned out in advance. I've seen so many nightmare investment properties come to dreams and become dreams come true. Now, there are 2 last things I do want to mention. And Lawrence, I usually go over time, so just cut me off anytime you want. You're smiling, so clearly I've met that criteria already, or surpassed it. We are in a unique time in the Bay Area in California. I went over the timeframes of the 1031 exchange, 45, 180. There is currently an extension out on the 45 and 180-day timeframe for an affected taxpayer in the state of California. We have never seen this happen quite like this in our tenure at IPX. And I got to tell you, it is really awesome for the right person. So if I had closed escrow today, April 12th, 13th, right? 45 days from today would be June 28th or something like that, whatever it is. I can't.
End of May.
End of May. See, told you, couldn't add. End of May. May 28th. to identify. That's only a month and a half. Because of the extension, if you're an affected taxpayer, which means if you're in one of the counties that was listed in the disaster relief, you would have until October 16th to identify that replacement property. Your 180th day would either be October 16th or the actual 180th day, which if you close pretty soon will take you past October 16th. But the beauty is the hardest part of a 1031 exchange is finding the ideal property within the 45-day window. This has been extended. The call to action, in my opinion, right now, if you own investment property in one of these counties, it's not if you own the investment property, if you live in one of these counties, is to unload that asset right now and do the 1031 exchange. And finally, with this 45-day identification period being the biggest problem, we've never seen more improvement exchanges and reverse exchanges that happen all the time. The reverse exchange is where you buy first and sell second. Most people like this in a market with limited inventory. The reason why they don't like the reverse exchange is you don't have the money from the sale yet. So you better have the cash to buy this property, or you better qualify for financing. And get this, we set up an LLC that goes on title at the close. So for residential property, conventional lenders will not lend to the LLC. You'll probably have to go private money. So it is more expensive. But you buy first and you have 180 days to sell second. The property that you're looking to unload works out beautifully for the right client. And the final thing is the improvement exchange. If I were to sell for $1 million, found the perfect property for $800,000 and wanted to put an ADU unit on it, I could do this in an improvement exchange. The way it works is we as the exchange company will go on title to that property. You'll identify what's going to be done in the 45-day window. Here's the catch and the kicker that usually stops it. Got to be completed within the 180-day time frame. If it can, it works well. In the city, probably ain't going to happen, but in other areas, very, very popular. And that's all she wrote. Unless you want me to go on. I tried to make it fast.
Thanks, James. I appreciate that. So I know we didn't get a chance to go through. I'm going to have the team just toss up a top 5 that we had related to 1031 exchanges, and it covers at least a very, very 10,000 foot level some of the things that you were talking about. Moderator, do we still have that top 5? Yeah. So James talked about identifying that replacement property within 45 days. Obviously, he talked about closing within 180, and then the extensions that exist because of some things that we've been experiencing. Qualified intermediary. This is important. This is who James and Ross are. They are the experts. They are the ones that know how to get it done and get it done right, so you don't invalidate your 1031 exchange and then end up having to pay taxes on a whole bunch of gains. So it's very important to partner with the right person.
I'd like to piggyback on that, Lawrence, because
sure.
Not only the knowledge that we can provide, yeah, that's great. But if we take your money and run off, it doesn't really matter what we know. You got to make sure that the qualified intermediary you choose is financially sound. I think we're all aware of what happened with SVB and with Signature Bank. And I got to tell you, I would not trust my money with the mom and pop company. I would only use the big boys, and I would want to know what kind of guarantees of performance, what kind of assurances, who's your parent company, all of the more important questions. And if you don't believe me, just do a Google search on American Greed, and there will be a segment on the qualified intermediary that took people's money, filed bankruptcy, whatever you want to call it. This does happen in the industry, so you need to be careful on who you select. We are the largest qualified intermediary in the business because we're owned by Fidelity National Financial, a Fortune 200 company. We do provide a third-party guarantee of performance of $50 million per file. We have a $100 million Fidelity bond and $30 million of error and omission insurance. I normally don't talk about it that much, but because of what happened in the banking industry recently, people have been asking me, how is my money safe? Where is my money? And we're like, it's at Citibank. If Citibank goes down, the whole world economy is going down. We keep it liquid. It's all segregated. We don't invest it. We don't take chances. It's important. It really is important. And we don't talk about it as often, but recently, and you had it on this list and I forgot to mention it again. It's very, very important.
No, absolutely. Especially given what just recently happened. And, the banking system definitely isn't what it used to be. There are some, it is fragile right now. So James is right. You do need to make sure that you work with somebody that is solid, that isn't going to be risky.
Just
right?
ask the questions and then ask for proof of it, because people would I saw this happen in 2008, 9, and 10. Are you bonded? Yes. Do you have insurance? Yes. That qualified intermediaries, all of it was expired. It's like, yeah, they had it. It's just expired. You didn't like provide proof. You didn't ask the questions, and it's important. It really is important. No matter how much knowledge we have, if the money isn't safe, there is no exchange, and you still pay taxes.
Yeah. In addition to that, obviously having a good accountant that understands it, the IRS rules, you need to have somebody in your corner, CPA that understands real estate investing. If you don't know anybody, we can certainly recommend. I'm sure Ross and James also have a lot of accountants that are very familiar with 1031 exchanges as well. All right, so questions and answers. I think there was a couple questions. Obviously, we're going to share Ross and James's information. Ross, you've been pretty quiet out there. I don't know if there's anything that you want to add to what James was saying.
Hey, Ross, tell them about FIRPTA. I think that's a big one. We're in the city. They need to understand that.
Yeah, FIRPTA is an issue. What happens very often is, especially in Northern California, a lot of foreigners have invested here. And over time, they take advantage of the market, they sell it, and they realize there's this 15% withholding for the feds. And then they think that, oh, by doing a 1031, you could automatically waive this FIRPTA. That's not the case. Doing a 1031 doesn't mean that it would get waived. The FIRPTA process is it's a process. CPA needs to get involved. You have to apply for a waiver. The waiver could take anywhere between 6 weeks to about 3 months to get a waiver. So, and then secondly, in a FIRPTA situation, it's unlikely that the owner even treated it as investment use, because number one, if they're in a FIRPTA situation, they don't have a tax ID number, which very likely they have not filed any US tax returns. So FIRPTA comes up often. It's a lengthy call. CPA needs to get involved. But as far as connecting it with 1031, it's a bit of a, very often it doesn't qualify for 1031. But
it's a nightmare.
Yeah, it's a conversation that the CPA needs to get involved with as soon as possible. And the other problem with this, the foreign party doesn't have a US CPA. So by the time it gets to that point, they're frustrated. They don't want to pay the 15% withholding. They don't want to pay 330% withholding. They don't want to hire a CPA. And it becomes, it's just a problem. So the sooner, if something like that were to come up, hopefully even in the listing phase, the FIRPTA question comes up and that is dealt with almost immediately, and to get the appropriate parties involved to get it possibly resolved before closing. Because in the last year or so, I get a pretty decent amount of FIRPTA calls. And some of those calls are 2 weeks before closing. You can't get anything done in 2 weeks. It's probably
the moral to the story is, if a foreigner is selling a piece of investment property, let's have that conversation before the property is listed, because there's steps that need to be taken to give it a chance for that withholding waiver to come across, because 15% on the sales price is a lot. That might even be more than the gain.
Yeah.
Yes.
For sure.
It's just a lot of steps involved, but the sooner everyone knows about it, the better.
Totally agree.
Now, do we have any other questions from the audience?
Somebody, I answered it on the chat. Somebody was asking about the depreciation. Are there tools to guide investors with determining appreciation? Oh, appreciation. I read it as depreciation. Yeah. Maybe I answered the wrong question, or I read things. My glasses don't work that well anymore. But for the appreciation, I can answer this as well. You could just Google search it. There's census reports that talk about this as well. But Google will take you a long way with the appreciation by location over the years. I got to tell you this, in California, things mostly double over 10 years in terms of value, but that does not ring the same everywhere else, especially in the Bay Area. But Google searching those numbers, you'll probably find a website that will provide you with that information. It's amazing how much information they have online now, unless you know of a better spot to go to, Lawrence.
No, I mean, that's a good option. The big companies out there that work with a lot of data, the Redfins of the world, the Zillows, they're the ones that have access. They do a much better job of analytics on that data because they pull a lot of that data from where all the sold information exists out there, the MLSs or the IDXs. So you can probably get information from Zillow as well. You might have to pay for it if they have a tool out there that isn't free, but I know those companies definitely have the information as well about appreciation in different areas of the country.
It's compelling information when looking to buy an asset that you're looking to not only get cash flow but appreciation on. Go ahead, Ross.
Yeah, it's also, I mean, it's valuable information. I mean, that's the $1 million question. When's the next area that's going to boom? But with that said, I remember, I think it was the last year of the pandemic, I was watching one of those finance shows, and there was a chart of the United States, and the whole chart was green. You know, Anytown, USA was anywhere between 8 to like 70% year over year. And I mean, that was just rental income. But then if you were to look at that chart, that's not a sustainable chart. That's a year-to-year chart. So a lot of this information that you would find, it is historical, but that doesn't necessarily mean that that's the direction it's headed. So some of that information, you know, you definitely could Google it and find the information, but again, it's not necessarily a sign of what's to come. So you kind of have to take it with a grain of salt. That's how I look at it.
Yeah, the best thing you can do is work with a real estate professional that really understands that market in that area. And if you have an area that you're interested in that is not the San Francisco Bay Area and is out of state or out of the Bay Area, Northern California, Southern California, let us know. We can definitely refer you to somebody. We're part of a top agent network, so we do know a lot of good folks out there. All right. Well, I don't think there are any questions, but I do want to thank Ross and from James for all the valuable information they shared today. This particular seminar is being recorded, so it will be available online. I know James unloaded a lot of information, and a lot of it might have just gone over your head, but if you want to replay it, you're more than welcome to. We'll definitely share more information for them in terms of their contact if you'd like to reach out to them and work with them on any upcoming 1031s you have. And obviously it will be in the slide deck that's shared as well, or the seminar recording. So you'll be able to see their information there. This is just one seminar in a series of seminars that we host. And as you can see, we have a home buyer seminar that's coming up. I think it's in a couple months. And then we also have one for selling and downsizing that I believe is next month. So we do have them throughout the year. Feel free to scan the QR code that you see on the replay or here right now to sign up. And we will be also raffling off that gift card and or what was it, a gift card to, I think, a restaurant or Amazon. We are gathering the entries. So if you attended today, you will be entered, and all the attendees for the first set of seminars will go into the drawing, and then we'll announce the winner at the half-year mark. But thank you for coming. Thank you, James and Ross. Pleasure.
Excellent.
Thank you, Lawrence.
Look forward to seeing you guys in person.
Absolutely.
Take care of yourself.
Excellent.
See you guys. Bye-bye.